Hey guys, Sean here. We have to talk about paper gold and what it'll take to break the system. Now, if you have been buying gold for some time, you know what the paper gold market is. It is an outrageous mechanism that is controlling the real price of gold. Now, the demand for gold is there. Investors are buying it and central banks are stockpiling by the truckload, but the price is still below $1,800 today. And a big reason is the paper gold market. So when we buy gold, we're talking about the physical stuff. Gold coins and gold bars that you can hold, not some paper IOU that tells you that your metal is locked up halfway around the world in some vault in New York or London. But what's insane is that this paper contract, which has no intrinsic value, controls the price of the physical gold. A derivative contract is dictating the price of the underlying asset. And if that isn't Twilight Zone economics, I really don't know what is. And this means it's no longer about the physical buying and selling of gold from suppliers to end users, but rather how much paper is being traded on Wall Street. So the more paper that's flying around the COMEX and the LBMA, the more likely the price of gold can be pushed up or down. Now, firstly, we need to understand how the paper gold market is fixed and controlled. It is a whole convoluted scheme, so I'll just give you the cliff notes and really simplify it down. Now, when people talk about the gold price, they usually mean the paper spot gold price, and this is set by two mechanisms: the London OTC wholesale market and the COMEX gold futures market in New York. Now, the London OTC spot gold market takes reference for what is called the LBMA gold fix, which is basically 16 banks logging into a system electronically to discuss and agree on the price of gold twice a day. And once they come out with a number, that number is used to set the benchmark for the gold price in the OTC market. And it is this benchmark that influences the price of physical gold and derivative products across the world. Remember, most central banks buy their gold through the LBMA's OTC market, and their physical purchases don't really affect the paper price. It is the big banks that decide what the prices are in the LBMA through the gold fix. Now, we're talking about banks like JP Morgan and HSBC, so keep that in mind. Now, the second mechanism is the COMEX futures market, which is basically paper contracts where gold is being traded for profit. Now, only a tiny fraction of these gold contracts actually expire and delivery of the physical bars is taken, and the majority is really just closed out for cash settlement. But if we look at the daily gold volume being traded, the LBMA and COMEX accounts for almost 85% of all trading activity. Those two exchanges set the true price of gold. So why does this matter? It's because of the way the LBMA is set up. And we are just going to focus on the LBMA gold market because it's the biggest and the most secretive of them all. Now, the problem with the LBMA is the issue of unallocated gold and how the gold price is being fixed. Now, both of which are entirely outrageous and just shows you how insane the gold market really is. Now, when you decide to buy gold from the LBMA, you'll be doing it through a bullion bank. JP Morgan, HSBC are examples of bullion banks. And the safest way is through allocated gold. And that's where you have the full legal title to the gold, right? A specific amount of gold and a specific bar with a serial number in a vault. Your gold belongs to you, and if the bank collapses, creditors can't go swooping in like vultures and take your gold bars away. But here's the problem: the majority of gold being traded or stored in the LBMA are unallocated gold, and that means if you have a claim on a certain amount of gold, if the bank collapses or somehow there's no gold left in their vaults, you are screwed. According to the LBMA themselves, over 90% of gold is traded in unallocated accounts. And that means if I were to sell unallocated gold to you through the LBMA, it's just a book entry. They swap the numbers from me to you and the transaction is done. And this is where the heart of the problem lies. No one can verify if all the unallocated gold is really backed up by the physical metal itself. In fact, it could be impossible. Now, the LBMA states they clear on average 20 million ounces of gold a day, or over 7.3 billion ounces a year. But the annual production of physical gold is only around 3,500 tons, or 112 million ounces. And that means there's at least 65 times more paper gold being traded than physical gold being mined each year. You know how crazy that is, right? For every ounce of physical gold, for every ounce of this, there is 65 equivalent ounces of paper gold floating in the ether. Now, 65 to 1, that is truly insane odds. And that's just counting only the LBMA. We aren't even factoring in the COMEX, because if we do, then even 100:1 is probably on the low end. And it's this volume of paper contracts that's drowning out the true price discovery of gold. So if someone wants to slam down the price of gold, they don't just start selling gold bars or coins, right? There's only so much physical metal you can sell on Earth. Instead, they sell paper contracts. So through margin trading and just a fraction of the cash, you can literally buy and sell an entire year's production of physical gold within minutes. If you have enough cash, you can move the market. And this is very important because the paper market can be used as a tool to push up or push down the price of gold. Remember, a rising gold price tells the world that the dollar is failing, and there are powers out there that don't want this truth coming out. So maybe you're thinking, what about GLD and all the other gold ETFs out there? Do these affect the physical price of gold? If I pump millions of dollars into the GLD, will it push up the spot price? Now, unfortunately, the answer is no. Gold-backed ETFs only represent 2% of the entire gold market being traded. So even if you buy out the entire GLD and you become Scrooge McDuck, your efforts won't even matter. It's the action in the COMEX and the LBMA that truly matters. Now, by definition, a gold ETF is backed by allocated gold bars. When you buy shares in a GLD, for example, the fund has to physically buy gold to account for all those shares that they issue you. But there's still counterparty risk. You still have to hope and pray that the ETF lives up to the bargain, to their obligation, and the gold bars are still in the vault, or you're screwed as well. So how about the Shanghai Gold and Futures Exchange? We can see that it accounts for 10% of global gold transactions. Surely that has an impact on the international price of gold, right? Not really. The problem with the Chinese gold exchanges is that they are price takers as well. Their price is derived from the LBMA and COMEX combo. And the issue is that gold only flows one way into China. It flows into China. It is near impossible for gold to flow out of the Chinese domestic market, except for those gold panda coins. You need to get a license, which is exceedingly rare. So all the gold in the Shanghai Gold Exchange really flows within China, and because of this, it can't really influence the international spot price. But it kind of makes you wonder what China is really trying to do, trying to plan with all their big stockpiles of gold. Are they preparing for a gold-backed yuan to challenge the dollar down the road? But the fact remains that the paper market is controlled almost entirely by the West. They are the price setters, while everyone else, including you and me, we are all price takers. This means the price of gold that we buy is based on paper contracts. Doesn't matter if it's gold jewelry or gold bar, you'll always be paying the paper price plus a physical premium. Now finally, the premium is based on supply and demand of the physical market. And most of the time, you can get a 1 ounce gold bar like this for 3 to 5% premium easily. But if supply really tightens and demand goes through the roof, then you can expect the premium to shoot up. But the spot price is always controlled by paper contracts. But does that mean you stop buying gold? Well, personally, I'm still accumulating when I have spare cash because it is still one of the few hard assets that can't be printed from thin air. But I'm under no illusion that the price of physical gold is actually much lower than what it should be if the paper markets are abolished. But to keep it real, the paper markets are likely never going to go away. It might change and there could be fewer paper contracts floating around in the future, but you'll never be 1:1 with the physical, because industries will always need the paper market to hedge their production, and end users of gold will need paper contracts to protect the downside. Plus, we have banks around that love trading in precious metals, so the paper market won't suddenly disappear. But let us speculate for a moment. Is it even possible to break the COMEX or break the LBMA and crash this paper trading system? After all, we had the nickel short squeeze that caused the LME to suspend trading. Nickel spiked by 250% and that literally broke the nickel market. Now, firstly, we need to understand that the nickel market is extremely small and shallow compared to the gold market. The average daily volume traded in the nickel market is only $4.6 billion compared to over $54 billion worth of gold traded daily just on the LBMA alone. And if you rope in the COMEX, it's more or less likely $100 billion. And that is a drop in the ocean compared to gold. So it's much harder to create a physical short squeeze in gold. But can it be done? How would you do it? Well, all it takes is for a hedge fund to buy up paper contracts in the COMEX and take physical delivery. You could drain the COMEX by buying enough paper contracts and demanding the physical metal. But how much do you need? Well, if we take a look at the COMEX vaults, we can see that they have a total of 28.7 million ounces locked away, but only 14.2 million eligible gold ounces can be sold to a new buyer, and the rest belongs to other owners. And this means a hedge fund can drain the COMEX dry with just slightly over 14 million ounces bought, or $25 billion, and that's not a lot of institutional money. If you're a hedge fund, this is a perfect way to initiate a short squeeze to get both the paper and physical price of gold to shoot up. But there is a reason why it won't happen. The powers that be won't allow it. A rising gold price is indicative of a failing currency. If any hedge fund does it, chances are their positions will be stopped out and they'll be forced to settle in cash. If it could be done, it would have been done by now. But there's still a possibility to break the paper gold system, but it will have to be initiated by Russia or China, countries that are outside of the system. And it's really simple. They will have to create an arbitrage system where traders will willingly rush to the COMEX and start draining it bit by bit. All Russia or China will have to do is to sell their oil or other commodities for physical gold. They just need to say, hey guys, you can now buy our oil or other commodities at a cheaper price if you settle in physical gold. Maybe the discount is 20%, maybe it's 5%, it doesn't matter. All that matters is that they set up a situation where it is profitable to drain the COMEX of their physical gold and then transport it to Russia or China for cheap oil and take profit. And this situation will keep rinsing and repeating until the COMEX vaults are empty and this shell game is exposed. Then everyone will start rushing to get the physical metal because trust is now lost. And this is one possibility, and at the rate things are going with all the sanctions being fired around, it could really happen. Then we might get a proper revaluation of the gold price. But I believe if China or Russia tries to pull this move, this will escalate tensions to a whole new level. Now you might be wondering, I don't want to touch paper gold, it is rigged. And I get that sentiment. Most of my gold holdings are in the physical metal itself. But I do hold some paper positions, and I'll tell you why. It is very likely that this game could continue for the next 10, 20 or 50 years. I don't have a crystal ball, and this means the price of gold will be volatile, and that opens up many windows to ride the volatility and sell when it gets too high for short-term profit, because the paper market will be there to slam it down in price again, at least for the short term. This is how the game is played. Don't hate the player, hate the system. But if you are a stacker, you can also use the paper markets to your advantage. You can make use of gold ETFs. Let's say you're looking to buy physical gold, but you can't buy a full ounce yet. There are two ways you can go about it. You can either save up your dollars and buy a few months time and really risk the price increasing, or you can buy fractional gold, but you'll be paying 10% or more in premiums, which just defeats the purpose. What I do is average into the GLD ETF, which is the gold mini shares, every week until I hit the amount needed for physical ounce of gold. Then I sell off my paper positions, take the cash and then swap it for the physical metal. And this way I gradually average in, and even if the gold price rises, I still lock in some gains. So in the short term, you shouldn't worry about the paper markets. Use it to your benefit instead. But to store your purchasing power and build generational wealth, you want to hold the physical metal itself. If you don't hold it, you don't own it. But I have to be clear here. The paper gold market, at least for now, is going to stay. And because it's around, there won't be any true price discovery of physical gold. However, it's not all doom and gloom. Gold is still a great store of value, and the paper gold market just keeps it more affordable for more people to accumulate. There's a very good chance down the road Russia or China might make moves to break apart the LBMA or the COMEX because they also want their enormous stockpiles of gold to revalue. Maybe it is to back their currencies with gold, maybe it's just to transfer wealth from the west to the east, and if that happens, you'll be glad that you held physical gold. So let me know what you think. Will the paper markets one day be broken, or will the smoke and mirrors continue forever? Let me know in the comments below. Stay safe, be sure to smash the like button, subscribe as we navigate through this economic insanity.